and almost everything at this point, because there's been a lot of noise, and now you have the billionaires brawling, and that's even louder noise. Whether it's meaningful to the market, I don't know. But you would have been well served if you cut everything out and just try and focus on the prize at the end of the rainbow somewhere.
Well, and I think that prize, Scott, is that, you're coming into this year, if your expectations coming into this year were that we're going to have some potential increase in tariffs, and I think that was pretty much consensus that we would see something. And so if you're going to go from a tariff rate from, say, 2.5% to, say, maybe 6.5% now, with the rollback of some of these reciprocal tariffs, your expectation is that you're going to have a hint of additional transitory goods-based inflation. But if you also look through to that cyclicality that Chris was talking about, that was a place where, we were more constructive coming into this year. And so we were perhaps expressing it a little bit differently than what Chris talked about. But I think if you look at the opportunity in the more cyclical sectors, if you look at financials, industrials, even healthcare, which has obviously been a laggard. But if you look at some of the names that we've been invested in, we have looked through those potential tariff impacts. We have looked through to the potential for an inflection higher in CapEx. And perhaps most importantly, the spread of AI outside of the technology sector. And so Chris talked about the broadening out within the technology sector. I would pull that even further out and look at those cyclical sectors, particularly areas like industrials and financials, where you're getting that productivity and those efficiency gains already. And we haven't even truly seen the implementation of AI into 26 and 27 yet.
Given your point of view, when people like, Ray Dalio comment on things, or Jamie Dimon, or even a day ago, when Ken Griffin was once again talking about the tax bill, the tariffs, how he said all of this, the tariffs, taking a toll on the U.S. economy. No part of you sits back and says, because it's a lag effect and he's right, and it's going to have an undeniable effect, it's a matter of when, not if? So
I think, of course, emotionally there's that response, but it's our job as analysts to turn off the emotional side of our brain.
But why is that emotional and not real? Fundamental. How could you do what they've done in terms of tariffs and think that there's not going to be any economic fallout from it? That doesn't sound emotional. That sounds like a smart way to sort of try and game out things, similar to a Fed raising interest rates and thinking that, it's a lag.
I would think about it this way, Scott. The undefeated rule of Wall Street, as we call it, is that attitudes are shaped by what's happened, not what will happen. And if you look at what the market's done over the last 2 months, we're 40 days off the low. S&P's up 19% off the lows. You would actually expect, after a 20% rally, attitudes to be far more bullish than they currently are.
Yeah, they're not.
They're not. So I actually think there's room for attitudes and emotion to get more in line with where the tape is. I'll give you a great example. If you look at any of the consumer sentiment data, right, we know how bad it's been. All the consumer confidence surveys have been in the first decile historically. You know what you historically should be doing when that's the case? Buying consumer stocks. I know it's tough to get one's head around that, but this data tends to be more contra than it is confirming. So I think the sentiment environment, of which you very accurately describe, is more compelling than anything else. That attitudes have not caught up with what the market's given it.
Should we take all this as a contraindicator? You agree with that?
I keep going back to that 2018 analogy. I know that the tariffs are different in size and scope. 2018, very similar. Once you paused it, you had to wait a while for better news, but the markets were up pretty big in 2019. So, investors that try to time these things, they almost always seem to be pulling out of the market at extreme economic policy uncertainty. The challenge is that's when you get some type of response, whether it's just a 90-day pause or at some point maybe something more dovish from the Fed. But again, when you get to these extreme levels of volatility, you get some type of response and investors get whipsawed by it.
Shan, catalysts ahead in your mind are what?
Scott, you mentioned at the top, I'm perhaps a little bit more concerned about the bond market. But although I would admit, I think we are moving into a range around, the 10-year and that sort of speaks to perhaps a little bit of additional stability. But the catalyst, Scott, is really going to be what we saw in expected capital expenditures by businesses. We had a big shoot higher in business confidence coming right off of the election. We've seen it come back down to 2020 levels, which really feels overdone, I think, in our view. And so if you look at some of the things that are in this tax bill, we can argue about whether it's going to come through exactly as it is now, but 100% first-year expensing of structures, some look back on depreciation. There are some pro-business aspects to this bill that I think could provide some stability, coupled with the negotiations on tariffs that could really catalyze businesses to invest in the second half of this year, create a little bit of momentum in hiring, and frankly, provide that additional foundational support for the consumer that we would need into 2026.
What about earnings, guys? I mean, first quarter, Brian, obviously was better than many people expected that it would be. There are those, though, who warn that don't take that as a sign that you're off the hook now for the second and third quarter. Even people who are bullish, like Ed Yardeni.
Right.
That's the case he's currently making.
Yeah, I mean, obviously anything we saw in the first quarter, backward looking, before all of these policy decisions were put forth. I mean, earnings are going to slow. Leading indicators of the economy, it's not like they're rocketing higher. They're pointing to growth that's going to be fine, somewhat maybe even below trend globally. And so, yeah, I wouldn't expect an outsized earnings growth environment, but certainly enough to continue to propel markets higher.
Enough to justify 22 times minimum.
Well, you're 22 times on the broad market. You're more, if you look at a median stock or you look at an equally weighted S&P 500, you're closer to more of an average. So the question around 22 or 24 times earnings is, are the concentrated names worthy of those multiples, not necessarily the other 493.
You view it the same way?
Yeah, I mean, we have 6 weeks now, basically, between now and the kickoff to earnings. June tends to seasonally be a very good month. Seasonality tends to wane in late July. We'll take stock then. But just with respect to the point on growth, I mean, first quarter was a 0% quarter. It looks like 2Q maybe 4.5 or 5%. Let's average them, right? We're somewhere in the 2.5% range. Throw 2.5 inflation on top. You're left with 5% nominal, and 10-year yields are 4.50 today. I think we're very much balanced here.
All right, we'll leave it there. Chris, Brian, and Shan, we'll talk all of you soon. To Pippa Stevens now for a look at the biggest names moving into this Friday close. Hi, Pippa.
Hey, Scott. Well, Circle is jumping another 40% today, building on the stock's 168% pop yesterday as it made its debut on the New York Stock Exchange, pricing its IPO above the expected range. Circle's USDC stablecoin is the second largest stablecoin on the market, behind Tether's. But Lululemon shares are plunging after the athleisure company cut its full-year earnings forecast, citing a dynamic macro environment. On the conference call, CEO Calvin McDonald said U.S. consumers are being cautious and intentional about their buying decisions. Those shares down some 20%. Scott?
For that, Pippa Stevens, we're just getting started here. Up next, we get you set up for Apple's highly anticipated Worldwide Developers Conference. Starts on Monday. We'll be there live. And later, class is in session with the professor, Jeremy Siegel of the Wharton School. He is standing by to tell you what he thinks about this market from here. We're live at the New York Stock Exchange, and you're watching Closing Bell on CNBC.
I was literally just following doctors' orders. I was literally just following
Apple's higher today ahead of its Worldwide Developers Conference on Monday, but with shares down near 20% this year, the stakes could not be higher. CNBC's Steve Kovac joins us now, along with Big Technology's Alex Kanchowitz, who is also a CNBC contributor. Gentlemen, it's good to have you here. Steve, I heard an analyst on an earlier program today call this a prove-it moment.
Yes.
You see it that way as well?
It's the chance to prove it. We'll see if they actually prove it, because like we've been saying all day, Scott, is a year ago was supposed to be the prove it moment. This was Apple Intelligence. This was the big debut. Their take on AI and the LLMs and this whole big ChatGPT moment. This was supposed to be their response. And they beefed it. And then they didn't make it happen. They failed to execute. The features that did launch have been unimpressive. The ChatGPT integration did go off without a hitch. However, it's not as good as using ChatGPT, the regular app. And then, of course, the big Siri miss, which was supposed to be their answer to ChatGPT. And we have no idea when that's going to come and what that's going to look like. So the question now is, what are they going to show us on Monday that kind of fills in those gaps that they left open for themselves?
It's all about the developers at the end of the day. So is what we think a prove-it moment really at a prove-it platform? Is it the right place to find out all the answers that we need to learn?
In my perspective, it absolutely is. So what we've seen with Apple is sort of a flip. The most important events used to be the hardware events, the iPhone rollouts. That was the flagship moment for Apple. That has shifted to WWDC. Of course, 2 years ago, we saw the Vision Pro rollout. Last year, Apple Intelligence. And you're right, it is all about the developers and what's built on top of the iOS platform, because the most important business unit for Apple is that services business. That's where the growth is coming from. If you look at iPhone shipments, according to IDC, 2024 was actually slower than 2023. The revenue is about the same as the year before, but that is likely because the average selling price of the iPhone is going up, which means all of the focus for Apple is about services. It's about what can be developed on top of that platform. We know there's going to be a big focus on the operating system this year. But as far as the big flashy prove-it moment, that was supposed to be last year. As Steve mentioned, we didn't see it. This year, in terms of the big AI advances, people are talking about it as a gap year, meaning we're not going to see much from Apple on that front. We have to wait to next year.
And no one else is taking a gap year, by the way. Yeah. Apple is. Yeah, right.
People are like doubling down on what they're doing at a really fast.
You can't keep up with
fast pace. You've described Apple coming into this event as facing threats on multiple fronts,
right?
Arguably more so than they have at any point in time under Tim Cook's leadership.
Right.
That's a fair way to look at that?
100%. So Alex and I were talking about this just now during the commercial break. If you look back, the biggest challenge that I can remember Tim Cook facing to the business was Samsung. Remember the threat to Samsung in the early 2010s? These big, beautiful screen phones, and Apple had these tiny phones that they were slobbering over these big Samsung phones, right? And then all of a sudden, Apple, we're just going to make a big phone. Off to the races. Samsung's a second thought. We don't even think about it, and it's been just pure growth from there. And now we see the growth in iPhone stalling. We see competition in China big time from Huawei. They're losing market share in their second most important market. So now we look at what they're facing today. The tariff situation, again, not something that they self-inflicted, but it is the problem they have to deal with. The Epic Games lawsuit, we're talking about developers right now. These developers want to make money too. And right now they're looking at this option to make web payments as a way to get around these App Store fees. What can Apple say to them to keep them in the ecosystem? Is their AI development platform, to your point, Alex, is it good enough to say, okay, we're going to stick with Apple instead of going to the web or somewhere else?
I feel like now also in the zeitgeist is Johnny Ive.
Yes. Oh, and that too.
And OpenAI. And Johnny Ive talking about devices and talking about legacy devices that don't seem to be as relevant as they once were or won't be as we continue to move forward in AI. Is that this overhang that we need to think about, that they're going to be thinking about out there always now?
I think they have to start thinking about it. They have been thinking about it for years. In fact, they released the HomePod a couple of years ago, which didn't work because their AI team was disappointing. It was their answer to the Amazon Echo and Alexa Inside. We didn't see much movement there. And you even have recently executives like Eddie Q, who run services, saying maybe 10 years from now we won't need an iPhone. Now, I think a lot of this talk is hyperbolic. Johnny Ive is saying the iPhone is a legacy device because he's working with an AI company right now in OpenAI. So of course he's going to position
anybody
himself.
Calling it a legacy device.
Well, at the same time, you got to think he's putting more pressure on himself than he's putting on Apple. They're putting more pressure on OpenAI because what if that device comes out and it doesn't blow us away the way that original iPhone did? Boy, is that going to be an embarrassment for OpenAI.
We've seen it come from other Apple veterans, the people that launched the
Humane bin,
which didn't work out. So this is a long-term threat. I'm not playing it down.
Johnny Ive. I mean, Johnny Ive puts his name on something.
Oh, it's
like Tom Ford. If he designs something, you know it's going to be hot.
Not necessarily. I don't think it's necessarily the truth with Johnny Ive. He obviously has done a lot of great work with Apple when he worked along Steve Jobs. Maybe he can recreate that magic with Sam Altman. Has he done anything after leaving Apple that makes us say after his Steve Jobs chapter he's the guy that he was? I don't think so. I'm not saying he's not going to do it, but I think that we've seen people try to come up with these AI devices. It makes sense. There should be a sort of an AI device or an AI voice that hangs out with you and sees the world as you do and listens to what you do. But is that going to be 2 or 3 years out, or is that 10 or 20 years out? I'm on the longer time frame. We talked about how search might be killed by generative AI. Google is posting amazing numbers with traditional search. I think it's going to take a long time before we move off the phone. That said, what type of phone is it going to be? Is it going to be an iPhone, or is it going to be a phone with, like, for instance, all of the Google AI features that we saw at Google I/O a couple weeks ago? That's the open question to me.
We're going to know pretty quickly too, right? I mean, the event happens. You guys are going to be back with me, and
literally as it ends,
right? Reacting to it, and you'll be the deciders as to whether the narrative was reset based on what you tell our investing community.
And the market will decide as well as they're watching this big keynote and listen to Tim Cook and his executive team explain what they see, how they see their platform moving forward. Look, so much of the stuff they're going to give us on Monday is free. It's going to be a free upgrade to your phone or a free upgrade to your MacBook. It's not going to move phones. So what are they going to do to keep that services business growing? That is what people are going to be watching for. Because remember, Apple Intelligence was supposed to be the thing that moves phones. They kind of hardware gated it, so you have to buy the new device in order to use it. Well, no one wanted to use it because it was subpar, and then they didn't fulfill their whole promise there. So
Apple tried to shift the narrative last year with the Apple Intelligence rollout, and we sat there. I think we kind of had mixed reactions because that vision would have caught them up to the rest of tech. And so I think this year, even if they tell us what's going to happen, we're going to definitely look at it more skeptically. I think for them to really shift what's going on now, it's going to take time or a surprise. I personally think they should try to acquire AI search engine Perplexity, which is trying to raise at a $14, $16 billion valuation, where Apple is doing a $100 billion buyback.
They need to have happen what actually happened after WWDC. Can we look at a one-year chart, please? Because from WWDC, that was the catalyst.
That was the optimism.
That was the catalyst that got the stock to an all-time high.
I was on the show every day last December, Scott, talking about these new all-time highs. ChatGPT just launched with Siri, and there's so much optimism and excitement around the big Siri update that was supposed to come February, March or so of this year. Then we got the news that it wasn't going to happen, and boom, all the air got let out of the balloon.
Yeah, we're not hearing supercycle anymore.
Yeah.
We'll see. It's going to be fun.
Maybe from Dan
to be with you guys out there as we all sort of build up and then react to whatever happens. Don't miss our coverage from Apple's Worldwide Developers Conference. We'll have the pregame show on halftime, noon Eastern, the postgame show right after. The event starts at 1 o'clock. We'll be back with closing bell from there with that postgame wrap. You'll see AK there. You'll see Kovac there, and many others too. And we hope you'll join us for that. Up next, you're going to see the Wharton School's Jeremy Siegel because he's standing by with his summer playbook for stocks.
Audio test. Am I coming through? Can you guys hear me? Where's there a problem with the audio again? Nobody can hear me? Okay. Looks like I'm okay. I was trading throughout the day today. Let me show you my trades here. This is the New York Open only. So I took a long here off the moving average, and I had to go just a quick trade, scalp. Then let's see here. Then I shorted here. Got out too soon, but I knew it wouldn't go very far. So then later on in the day, I opened the charts. I want to get in earlier here once it cleared this red bar, but wasn't fast enough. So I got in here, and I thought they would retest the highs. That's why I got out right over here, as you can see. And let me see where else here. See the trades here. Okay, so looks like let me see. Yeah, I got in here long, and I started getting out. I thought it would be just going right to the moving average. And then it just went past that and just swept through again. So I'm happy with that trade. Then another trade was here, I think maybe for a break even or so, maybe a few points, maybe 5 points or so. And then towards the end of the day here, as you can see, I shorted. Got out here, then shorted again, start getting out.
Today's better than expected jobs report.
So, and didn't really like this price action, one bar up, one down, one bar down, but as long as it stayed below and it closed below the 20-day moving average, I was happy and held on to the trade, and I added, of course. So I had, I think, 2 contracts here, got out with one, left one running. Then I got in again, and I think with 2 contracts, and then I saw this bar again. It just didn't like that move. I was gonna get out once it cleared this tail here, but it stayed below the moving average. So I added, and I got out here once and twice. So that's pretty much my trading for the day.
Have come. Now, all that said, and I've said this before, the market is looking at a 10% across the board, 30% China. Yeah, I know there's 50 on aluminum and steel, but basically they're looking at that as the base case. If that blows up, all bets are off. But at this point, it looks like that assumption is holding.
Professor, this whole thing is about playing the probabilities, right? You play the odds on what you think is most likely to happen, and then you invest accordingly. So if I say the odds are that we're going to have a trade deal with China, you'd say, well, I'd bet on that because the president needs it. Well, the odds are that we're going to have a tax bill deal, and that's going to get through. And you'd say, well, the odds are we're going to have that too, and the president needs it. And then I'm going to say, well, the odds are that the Fed's going to cut rates next. I don't know if it's going to be tomorrow, July, September, or early in 26. But I know that their next move is going to be a cut. You'd probably say I'd bet on that, too. Therefore, where's the rub? I mean, that sounds like a pretty decent story to me.
Yeah, it's an excellent story. Now, either of those could go south, though. I actually think, despite all the debate about the tax cut, that's going to happen. We're going to get it. There's going to, whether salt is the way it is or slightly, we are going to get that. They may have to say, if they don't do it in time, they may have to separate out the debt ceiling for a temporary 6 month until they work it out. But, that is a 95% confidence plus for me. Trade deal with China that, keeps it as it is and the rest of the world. I think that's more like an 80% probability. And a Fed cut. Now, when, very honestly, I think despite the fact that today's employment report was good, I've been for a precautionary cut. It's my belief Fed funds should be about 100 basis points under the 10-year. And it's only 13 or 17 basis points under the 10-year. So in some sense, I do think the next move should be down. And I think that's, if you ask me something I'm a little worried about, if the data does turn soft, is the Fed too late? And that probably is probably my biggest worry, if you would talk about a worry going into the second half.
Well, but Professor, you've changed your point of view on that multiple times. So I'm surprised somewhat to hear you say that you're for a cautionary cut. You were, yeah, but then you weren't. Why are you now? The economy still looks pretty good.
Well, let's put it this way: we do have tariffs. When I went saying, "Hey, no cut," that was before the tariffs. And the tariffs are a consumption tax. They are going to slow us down. Now, the reason why, and very honestly, and I said this before, if there were no tariffs at all, or let's put it the first term Trump tariffs, I think we'd be in all-time high territory right now. But I think at 10% tariffs, that's a challenge to corporations. Adversity is the mother of invention. Hey, how can I lower costs? And here's where AI comes in. Am I implementing AI in the way that I can best to offset the effect of the tariffs? This could be an accelerator to AI adoption and offset the negative effects of the tariffs. So, yeah, I'm not for tariffs. I still think that's a negative outcome for the U.S. economy, but there's enough positive factors going on there that can still lift the stock market.
But the Fed has been well served in waiting. I mean, we have higher tariffs today than we probably would agree that we're going to have 6 to 12 months from now. And in an environment where we have higher tariffs than we think are going to exist down the road, we're only 2.5% away from a new high on the S&P 500. And we're going to put a decent number in the books, more than likely, for GDP in the second quarter. And we just put a better number in the books for corporate earnings in the first quarter than most people even expected. Why in the world do we need a rate cut in that environment?
Well, first of all, if you average the first and second quarter, it's much more mediocre. I think, by the way, both are distorted. I think the first quarter is distorted down and the second up, and that's because of the tremendous swing in imports because of the threat of the tariffs. And secondly, let's face it, Scott, the impact of the higher prices of tariff goods is only going to start appearing into the next 3 or 4 months. And so a lot of people say, hey, higher prices, yeah, economists are saying that, but how often are they right? I'm not going to believe it until I see it. I think they're going to see something, and that's going to be a slowdown. And I say I'm not bearish because I think firms are going to work really hard to increase productivity to offset that. But I think that slowdown and the Fed should see through tariffs. Tariff inflation is not something to tighten, but there is slower growth. Look at the trend of employment. Look at the trend even of GDP. If you take 2 quarters averaging, does, in my sense, justify a lower Fed funds rate at the present time. Will it be a disaster if they don't? No, it won't be a disaster. But very honestly, given trends, looking through inflation, looking at the 10-year, listen, you know, look at how much every 10 years very well behaved. Inflation expectations by the difference between the swap rates, the tips rates, all those are very well behaved. You know, the Fed could lower rates at the present time.
Well, you're making music to the president's ears. We know that because he wants them to cut now, too. Always fun, Professor. Good weekend to you. We'll see you soon.
Absolutely. Thank you, Scott.
All right, Professor Jeremy Siegel. Up next, we track the biggest movers into the close once more. Pippa Stevens standing by with that. Tell us what you see.
Well, Barclays is bullish on an under-the-radar data center play, sending shares soaring. The stock to watch coming up next.
Less than 15 from the close. Let's get back now to Pippa Stevens for a look at the stocks that she's watching. What's high on your list today?
Check out DocuSign because it is sinking after its Q1 billings came in lower than expected. prompting the company to cut its full-year billings forecast. Evercore ISI, which has an inline rating on the stock, said today's reaction is a little overdone if taking a longer-term view, but that the billings fog first needs to lift. And Solaris is surging after Barclays initiated coverage on the energy infrastructure company with an overweight rating, saying it's the leader in distributed power, with more than 60% of its coming power growth allocated towards data centers on long-term contracts. Those shares up 10%. Scott?
But thank you very much. Pippa Stevens, still ahead. Walmart's shareholder event just wrapping up. We do have a live report from the company's HQ coming up. There is the stock today. We're back after this on the bell.
No time to wait.
All right, coming up next, Robinhood hitting a fresh all-time high. We're going to tell you what's driving that move today in the market zone, which is next. We are now in the closing bell market zone. CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day. Plus, Courtney Reagan with the biggest headlines out of Walmart's shareholder meeting, and Kay Rooney on Robinhood adding to its mega rally this year. We do start with Courtney Reagan telling us what happened with Walmart today. Hey, Court.
Hey, Scott. Yeah, so Walmart just wrapping up its annual Associates and Shareholder Week. There were 35 events, 7 announcements, including an expansion of its drone program and explaining how it's using AI to better enhance the digital experience. But it all sort of culminated with this executive Q&A with the members of the media right here behind me at the University of Arkansas. And Walmart CEO Doug McMillon said that he's not seeing consumers change any behavior when it comes to possibly stockpiling ahead of possible price increases from tariffs. And then he was asked, well, what's it like to run a retailer in a political environment where the president can and has posted about you personally and or your business? And he said, quote, we've always had to be thoughtful about what we say, and that's still true, but we're super practical people. We're just trying to be good retailers. Remember, Walmart had said in its most recent earnings report that it would try to mitigate as much of the cost from tariffs that it could, but with tariffs at these levels, it was going to have to raise prices in some cases. Walmart shares since the April 2nd announcement are up about 10%, but that's slightly underperforming the XRT, which is up about 12% in that same period of time. Scott?
All right. Thank you, Court. Appreciate that. That's Courtney Reagan. Now, Kay Rooney on what has Robinhood off to the races.
Scott, well, it is continuing this massive run-up. We've seen shares of Robinhood have roughly doubled so far this year. The crypto and market rally have really helped that. And then overall trading activity has rebounded. As we've been reporting, there has been a lot of dip buying by the retail crowd this year. One factor, though, driving today's action. So there's some new speculation that Robinhood might get added to the S&P. Bank of America writing in a note they view it as a prime candidate for the S&P 500 with the next rebalancing, which could be announced later today. Goldman Sachs also with a bullish note this week pointing to Robinhood's May trading metrics, which imply better trading volumes across products. They talk about higher margin balances and some momentum for assets under custody. Overall, they're constructive on the structural growth of that business and retail trading and the whole backdrop as well. They're also moving into wealth management and banking. So Robinhood has been able to diversify revenue a bit, but you're seeing a much more bullish sentiment lately on the street, Scott.
All right, Kate Rooney, thank you very much for that. To Mike Santoli now as we try and get that 6,000 close on the S&P.
Looks like we're going to be there. You know, we were about 0.5% from here 2 weeks ago, and the market just sort of gently calmed down and reloaded. And the jobs report today, even though there was kind of a soft underbelly, even though it wasn't really that strong in terms of momentum, it was good enough to kind of kick the concern about the hard data and the real economy down the road a bit. We're getting a little bit close to the old highs, above 6150 or so, you know, less than 3%. It would be odd if we didn't make a decent stretch for it, not in a straight line, but within coming weeks. That being said, you know, we've now have a market where the stress is kind of drained away. We're assuming that pretty favorable things are going to be happening. The VIX is probably going to close under 17. That's the first time since late February when we were in a pretty comfortable spot. You see, a lot, you know, broad participation, cyclical stocks moving fine. So it all works together pretty well. I don't think you have people being over exuberant, but the Robinhood move is interesting because that pocket of the market is pretty fevered right now, and you have retail traders gunning stocks and options, inflating Robinhood's valuation, which makes it eligible for the S&P, which excites retail investors about it going into the S&P. So the best trade is probably after it gets announced, not after it goes in.
All right, good stuff. Mel's going to bring us out green, as you said. S&P right on that line at 6,000. We'll see where we settle. Good weekend to you, Mike. Good weekend to all of you watching, and continue doing so in overtime.
That bell marks the end of regulation. Housing and Urban Development Secretary Scott Turner ringing the closing bell at the New York Stock Exchange. Tech NYC doing the honors at the NASDAQ, and a rally in the markets on the back of a better-than-expected jobs report. The S&P touching 6,000 for the first time since late February. Tech was the best-performing sector of the week, up more than 3%, led higher by chip names. Crude closing in the green, posting its best week since October. Broadcom shares, though lower following its earnings. Despite the move, the stock's higher for the week, up 39% in the past 3 months. Lululemon, the big loser on the day, its worst day since 2020 after cutting full-year guidance. And DocuSign sinking after billings growth was slower than expected in the first quarter.
Well, that's the scorecard here on Wall Street. Welcome to Closing Bell Overtime. I'm Morgan Brennan along with John Fort. The jobs report comes in better than expected. Stocks moved higher with the S&P breaking back above 6,000. All major indices closed higher for the second straight week. It's the first back-to-back weekly gains that we've seen since May 2nd. So what is that telling us about investor sentiment? Well, let's bring in Mike Santoli, CNBC senior markets commentator. Mike, talk to me about this rally. We discussed it yesterday. 6,000 might be a round number. It might not be the technical level that investors and traders were watching, but certainly a round number. How does it speak to the momentum we have seen in stocks despite bond yields moving a little bit higher again today?
Yeah, I mean, Morgan, look, investor sentiment has grown more comfortable, and it's grown more comfortable because you have this mix of the real economy, the hard data has been hanging in there enough, and I think I put the jobs report in that category. It's good enough to kind of push off some of the worries, even though it doesn't show acceleration. And then you have the brute force of Mag 7 mega cap growth earnings that were just so strong, it just enabled that part of that market to really revive and drive the indexes higher. Obviously, we have the makings of some progress on trade. I think we're pricing in a fair amount of de-escalation on the tariff front. We have this talks announced with the U.S. and China on Monday. It kind of doesn't matter what happens or what comes out of that, in my view, if it's part of a process of just declaring victory on some level and trying to get past the issue. So we'll see if that all fits together. I would point out we got to 6,000 for the first time 7 months ago, right after the election. So it's enabled this market to kind of just retread that old ground and still make it feel like it's progress because of how deep in the depths we were 2 months ago.
Yeah, I think we're something like only 2.5% below the all-time high we saw back in February now for the S&P. Mike, stay with us. For more on the jobs report specifically, let's add to the conversation Apollo Global Management Chief Economist Torsten Slok as well. And Torsten, do you want to get your thoughts on what we saw in that jobs report? You're the first person that came on CNBC and said there's a divergence between soft data and hard data until the hard data catches up. The soft data is concerning, but it doesn't mean we're tipping into recession. How do you see it now coming off of a jobs report that was better than expected, but still shows signs of softening in the labor market?
You're right, Morgan. And that's exactly the backdrop here, namely that we had, of course, a very turbulent period in April. And that's why it was very significant relief today that the jobs numbers were actually still relatively decent. It is still a downward trend, as Mike just was saying. And we are having a little bit of a worry in the market, of course, with wage inflation moving higher. But the big picture really here is that the market has been trying to assess what is the magnitude of this shock that the trade war was. It was obviously not a shock that had the magnitude of COVID or of Lehman, and the magnitude of the shock was, of course, at least up to this point, so mild that it hasn't quite yet been weighing on the hard data. But Morgan, to your question, we should expect in the market that in particular over the next several months, now companies are adjusting to these high levels of tariffs. It will weigh more and more on earnings. In particular, we just heard Walmart say also about this today that they were continuously worried about the negative effects. So taking together both the trade war still being an impact on earnings over the next several months and quarters ahead, and at the same time also the continued move high in rates, there's still plenty of things to worry about when it comes to the headwinds to the economy.
Torsten, how much do these numbers, you think, reflect what's actually happening now, given the pull-ins that we've had from the various reactions to the Trump administration policy, and also given the expectations on the implications of some of that perhaps inventory build for the second half?
Yeah, that's a very important point because it does, of course, take time to slow the economy down. And what really is going on is that companies are trying to figure out how should we respond to this level of tariffs? Of course, there's discussion about will these tariffs be permanent? Are they temporary? How long time should we expect them to be in place? But at the moment, if they do stay at these levels, we should expect to see companies, in particular, of course, in the sectors that are vulnerable to trade, continuously adjust. And that adjustment, that's been recognized also by both Scott Bessent and, of course, and Trump, even Navarro, that there is an adjustment period. And we should not expect that that will just be a few weeks or a few months. It's something that is going to take time. So this is still a headwind when it comes to the earnings outlook for the S&P and to GDP. The Yale Budget Lab is predicting that the drag on GDP growth from the trade war will be minus 0.7. So that's not a recession, but it's still enough of a drag to put some upward pressure on the unemployment rate for the next several months. So to your question, we should still expect to see going forward, especially combined with rates moving high in the long end, that there is still a lot of challenges for the economy. Not enough to generate a recession, but definitely enough to give it some significant headwinds.
Mike, you mentioned that we've seen 6,000 before. How is investor sentiment, particularly retail? There had been this sort of very big bifurcation between what institutions were doing and what retail was doing, I guess redefining what smart money is, perhaps.
Now until we get kind of final numbers, although I would argue there's also a bifurcation within retail. I think the traditional kind of long-term oriented buy and hold investor, if you listen to what they say in surveys, if you look at some of the flows into traditional equity funds, they're not exuberant. They actually have remained pretty cautious. I think that there is, though, this much more active thread of retail traders who are just in the game all the time, very quick to buy dips, very quick to press momentum trades, and that's been working so far. So one of the things I would point to this week, and maybe in retrospect it'll seem important in one respect or another, is we had this Circle IPO. You are starting to see the window open up for IPOs. That's a feature of the bull market that we've only had sporadically, and that's sort of a positive until it tips over into getting into kind of silliness and frothiness, and I don't think we're quite there.
Yeah, and of course, huge moves in Circle since it started trading yesterday. We're going to talk a little bit more about that later in the hour. But Torsten, I want to go back to wage growth here and what we saw in this morning's report, because the fact that it came in stronger than expected and that we do continue to see wages grow both on a month-over-month basis and a year-over-year basis. If you start to see inflation ignite again, but wage growth continues to outpace it, doesn't that help offset the worries around stagflation?
That is correct, because then you have real income growth. And real income growth is, of course, very important because that is what ultimately drives the consumer. But the challenge here, of course, is that does require that CPI and consumer prices do stay low. The challenge, of course, for the Federal Reserve is that they need to look at both. And wage growth being high, it is, of course, a little warning sign that the Fed will just not be able to cut rates as quickly as we thought just until more recently. That's why the market has now been pricing that the Fed will stay on hold for longer. And that is, of course, why the main theme here in markets really is that rates will stay higher for longer because inflation, including wage inflation, will stay higher for longer. And that's, of course, good for fixed income investors. And this will continue to be a headwind to the S&P 500 because combining that with the upward pressure on rates also coming from the fiscal side, you both have the front end going up because of inflation risks, and now you also have the long end going up because of fiscal risks. So combined, the yield curve will stay elevated, and that continues to be a very important theme in markets.
Mike, what's the most important next macro benchmark we're going to get?
Probably macro CPI next week, I would say, and really how the bond market, digests whatever we do get out of there. We are in this period where there's not a lot of alarm on either side of the employment or inflation mandate, but we're not far from tripping into that, either a growth scare or something that seems like sticky inflation. And here we are with a wait and see Fed that we're not going to be able to deal with. I also keep pointing to July as a confluence of a lot of things. You're going to get the tariff deadlines expiring in that month. You're probably going to have to really get down to it on the tax bill going through Congress. You got a Fed meeting late in July. Who knows if it'll be live, but it'll be the last one till September. And the seasonal patterns in the stock market tend to turn a little bit more negative or less favorable in July. So maybe that's where you might look toward to say you got some challenges ahead.
All right. Well, Torsten Slok from Apollo Global, thank you for joining us. Mike, we'll see you in just a bit. Shares of Tesla rebounding about 4%, recovering some of what was lost in yesterday's Trump-Musk war of words.
So now that Elon Musk's time as a government employee is really over, is his return good for Tesla, or has he become too polarizing? We're going to discuss and debate when Overtime returns. And we're watching shares of some of the air taxi operators, Joby Aviation, Archer Aviation, and AeroVironment, all rallying on the back of an executive order focused on development and commercialization of unmanned aircrafts as well. That spike into the close just a few minutes ago.
50% off.
Welcome back to Overtime. A big week in the IPO market. Shares of Omada Health soaring in their debut today. Virtual healthcare company priced at $19 a share, closed more than 20% higher, up about 21%. Also, check out shares of Circle. This is another big gain in its second day as a public company. The stablecoin operator priced at $31 per share in its IPO earlier this week. It nearly quadrupled in its 2 days of trading. That puts its market cap in line with the long-standing traditional financial institutions, banks like Fifth Third, M&T, and State Street.
Now, let's turn now to the very public breakup between the President of the United States and the world's richest man. Tesla bouncing back somewhat today, still down 13% since Monday on the back of yesterday's slide. That's its second worst week of the year. Meantime, the New York Times reporting President Trump has decided to sell the red Tesla he got in March and told everyone else to buy. You're looking at a live shot of that car still parked on the West Executive Avenue at the White House. And joining us now is Ross Gerber Kawasaki CEO and President, and Brett Winton, ARK Investment Chief Futurist and a member of the ARK Venture Investment Committee. Both are shareholders in Tesla. Welcome, guys. Happy Friday. Brett, how did you calculate the valuation benefit that Tesla got from Musk's closeness to the president and from, that Tesla buying endorsement that's sitting there in the driveway still? And how do you kind of reverse that out now?
I mean, I think it's clear that Elon Musk has a different strategic view of the playing field than almost anybody else does. And on the surface, his actions may appear erratic, but if you look over time, those actions lead to long-term value creation for shareholders and advance his companies towards meeting their mission. And we think between Neuralink, SpaceX, Tesla, these are all companies that are actively changing the world. And that's why we're invested in them. And we believe that he's leading them in that direction, assertively and effectively.
Ross, that sounds to me like the trust Elon, look how right he's been so far based on stock performance. Why is that not right here?
Well, this isn't the same Elon that we were dealing with 5 years ago, that's for sure. And I think that the toll that his lifestyle has taken on him has finally reached a point where it's been like monumentally detrimental to the future vision that Brett's talking about. So as much as I like the vision of Tesla that Elon has for its future, it has to be actualized. And to actualize that, he needs support from the United States government. Tesla is a government-supported entity. It receives billions of dollars a year in subsidies from the U.S. government, and losing these subsidies are really, really bad for Tesla. And many of Elon's other businesses will be greatly affected if the government begins working against him. So this is a strategic error of epic proportions, and the sooner that he can apologize to Trump and try to get something back in his good graces, the better. But now having all the MAGAs selling their Teslas is about the worst case scenario you could imagine for Tesla.
Brett, I mean, the fact that Tesla's down, 15% now on the week, and we know a lot of that happened yesterday. There's a little bit of bounce back today. You just mentioned his other companies, which are privately held, SpaceX, there's Boring, there's Neuralink, XAI as well. Is this a situation that has ripple effects to all of the different companies? And if so, how do you quantify the impact to the broader Musk ecosystem, if you will, or is it outsized for Tesla?
Sure. I mean, because we have exposures to most of those companies, we assess, the thesis risk against those companies with any meaningful piece of news that occurs. And broadly, the reason that those companies, that we invest in those companies is because they are doing things that no other company in the world can do. The incremental car sale isn't as important to Tesla as launching robotaxi this week. Neuralink has installed its devices more than any other brain-computer interface company in the world. And SpaceX is really the only game in town in terms of, lofting astronauts to the space station, as well as going to Mars. So there is like the near-term volatility, disruptive innovation looked at very closely, often appears messy. And our job is to manage that exposure on behalf of our clients. It's why active management is so important.
Ross, a week ago, the narrative was this will be great for Tesla and Musk's other companies and with the case of Tesla specifically. Tesla is Musk. Musk is Tesla. We'd heard that from a number of guests on the show in recent weeks. Is Tesla a help is Musk a help or a hindrance now, given what we've seen in the last couple of days?
Well, it's a tough one because obviously he's a very talented engineer. He has tremendous, skills, and applying his 100% focus on Tesla was actually what I had hoped for some time, and this whole side show at the government was wholly unnecessary and very detrimental to Tesla. So on one sense, having Tesla, and Elon back together at this crucial part where they're launching robo-taxi, which basically doesn't work. So, he's got a lot of work to do. And so that's the good. But he seems to have doubled down on the negative side of Elon with the marketing and the view of the company so bad, and then to, really start a feud with, whether Elon likes it or not, Trump is the most powerful person in America. And so, having money is one thing, but being the president of the United States is the president of the United States. And that involves things like regulation of robo-taxis. It involves things like SpaceX contracts and supporting his companies. Right. It's a very, combined with the government. So none of this will be good for Elon.
Brett, it's interesting. I don't think anybody, well, very few people in here, were suggesting that Elon Musk should apologize to President Biden when he was the president and had the power that he had. It seems like both President Trump and Elon Musk are protecting their brands here. Neither wants to seem captured. Musk saying yesterday he's going to be around for a long time. Should he apologize?
No, I don't think he has anything to apologize for. I mean, Musk is a very principled individual. I think that's clear. And he's adhering to those principles. His goal is to achieve the mission that his companies have laid out to, make humanity a multiplanetary species, to deliver the abundant future that we deserve with Tesla, and to allow kind of our relationship with computers to fundamentally change with Neuralink. And, his relationship with not just President Trump and President, former President Biden, but with leaders around the world, is in the interest of making sure that those companies can accelerate as quickly as possible. I think that's what he's been focused on all along. And from an outside observer's perspective, sometimes you say, that's a funny move he's making. But the body of evidence over time has demonstrated that he has a reason behind it. And again, if you look at the track record, he has managed astounding results across a number of his companies that no other company has been able to achieve.
Okay, Brett Whitten and Ross Gerber, thanks for joining us to discuss. Well, we just touched on it a little bit, but let's turn to Musk's other big company, SpaceX. As the Trump-Musk feud escalated, SpaceX got caught in the crossfire. The president threatening to pull government contracts and Musk threatening to decommission the Dragon space capsule. SpaceX has $22 billion worth of government contracts. Its rockets launched key national security missions, science missions for the government. Its Dragon capsule ferries people and cargo to the International Space Station. Starlink provides broadband connectivity, including to the military. It holds contracts to bring the ISS down from orbit at the end of the decade, and the Starship mega rocket that's under development will eventually land American astronauts on the moon. And while more competition is coming in the space sector, SpaceX holds a wide lead over everyone else. That's also why SpaceX is the most valuable private company in the world. It's currently pegged at $400 billion, according to secondary market site Forge Global. And while Tesla shares tumbled today, funds holding SpaceX also felt the pressure yesterday in particular, especially the Destiny Tech 100 fund, ticker DXYZ, that did bounce back today. But it is 50% weighted to SpaceX. And as all of this plays out, others to watch do include Cathie Wood's ARK Venture Fund and Ron Barron's Focused Growth Fund. SpaceX is the top holding in both. Also, keep an eye on other pure play space stocks. Rocket Lab closed up 9% today. It's up 155% in a year. And taking off after the election, it launches rockets smaller than SpaceX's and makes satellites as well.
All right, yeah. Well, Apple shares down 18% this year following a list of setbacks. Can Monday's big worldwide developer conference reverse the company's downtrend?
And while Apple has struggled, so have small caps. The Russell 2000 down 4% this year, underperforming the major averages. But is a turnaround coming? This is seasonally typically a good time for the small caps. We're going to discuss that. It's coming up next on Closing Bell Overtime.